Imagine a casino where every sign says low risk. The floor is spotless, the dealers smile, and everyone tells you it's safe. But after years of playing carefully, you're still losing. Not in a crash, just quietly, consistently. That's what a rigged market looks like. No villains, no secret rooms. It's much cleaner, more boring, and far more effective. The most dangerous systems don't feel dangerous, they feel responsible. Millions are pouring savings into markets they believe are safe, unaware the rules changed years ago. The promise of safe returns is finally colliding with reality. Let's slow down and see how this actually works. When most people hear the word safe market, they think of stability, government bonds, large, profitable companies, broad market indexes, assets that don't swing wildly, don't collapse overnight, and don't make headlines. Safe means predictable. Safe means boring. Safe means grown-up. And for a long time, that idea wasn't wrong. In the old story of investing, risk and reward were balanced. If you took more risk, you might earn more. If you wanted safety, you accepted lower returns, but at least your money was protected. That trade-off was the entire moral logic of finance. Then something subtle happened. The world became obsessed with stability. After every crisis, .com, 2008, the Euro crisis, COVID, the same fear echoed through governments and central banks. What if the system breaks? So they stepped in. Interest rates were cut, then cut again, then pushed to zero, then below zero in some countries. Central banks started buying government bonds, then corporate bonds, then mortgage securities, then almost anything that looked important enough to fail. The goal was simple: make markets safer. Less volatility, less panic, less pain. And it worked. Markets stopped behaving like wild animals and started behaving like well-trained pets. Prices didn't fall as much. Crashes recovered faster. Risk felt managed, but safety has a price. And here's the part nobody likes to say out loud. When you remove risk from a market, you don't destroy it. You transfer it, usually to the people who can't see it. Let's talk about bonds for a moment. Bonds are supposed to be the ultimate safe asset. You lend money. You get interest. You get paid back. Simple. But when interest rates are pushed near zero, something strange happens. A bond that once paid 5% now pays 1%, then 0.5%, then maybe less than inflation. So investors face a choice: accept guaranteed loss or take more risk. And this is where the rigging begins. Not by cheating, but by design. Because when safe assets stop paying enough, everyone is forced to move outward on the risk curve. Pension funds buy stocks. Insurance companies buy private debt. Conservative portfolios quietly add leverage. The market looks calm, but under the surface, it's stretched. Like a bridge carrying more weight than it was built for. Not collapsing, just bending. And here's the uncomfortable math. When trillions of dollars are forced into the same safe trades, prices stop reflecting value. They reflect pressure. Indexes rise not because companies are more productive, but because money has nowhere else to go. Government debt explodes not because it's healthy, but because it's the only asset big enough to absorb the demand. Safety becomes crowded, and crowded safety is fragile. Now let's talk about stocks, specifically index funds. You've probably heard the pitch. Don't try to beat the market. Just buy the market. It sounds wise, humble, statistically backed. And again, for a long time, it worked. But think about what an index fund actually does. It doesn't care if a company is innovative. It doesn't care if a stock is cheap or expensive. It buys more of what's already big, simply because it's big. So when money flows into index funds, the largest companies get the most buying pressure. They rise, which makes them an even larger part of the index, which causes more buying. It's a feedback loop, not a conspiracy, a mechanism. And the bigger this passive system gets, the less price discovery matters. Stocks move not because of fundamentals, but because of flows. Again, the market looks safe. Volatility is low. Everyone is diversified. Nothing seems wrong until something breaks. Because when everyone owns the same assets for the same reason, selling becomes synchronized. There's no villain pulling a lever, just a system designed for calm until it isn't. Here's where the word rigged earns its place. In a truly free market, price sends signals. Risky assets are cheap. Safe assets are expensive. Capital flows to where it's productive. But when central banks suppress volatility and backstop losses, those signals get distorted. Risk looks cheaper than it is. Safety looks safer than it is. And the people closest to the system, large institutions, banks, funds, understand this. They can borrow cheaply. They can hedge. They can exit early. Meanwhile, regular investors are told to relax. Zoom out. Don't panic. Time in the market beats timing the market, which is true until it isn't. Because time doesn't protect you from bad math. If returns are pulled forward by policy, they don't disappear. They come from the future. And eventually, the future arrives. Let's add one more layer. Inflation. Inflation is the silent tax that makes safe markets dangerous. When your bond pays 2% and inflation is 5%, you didn't earn money. You lost purchasing power. But the statement doesn't show a loss. The balance didn't go down, so it feels safe. That's the trick. Safe markets often don't take your money outright. They just slowly make it worth less. And this is why the system doesn't feel hostile. It feels gentle, professional, responsible. You're not robbed. You're deluded. Now zoom out. Who benefits from this setup? Governments can borrow endlessly at low rates. Corporations can refinance cheaply. Asset owners see prices rise. Debt becomes easier to roll over than to repay. Growth becomes optional. Stability becomes the priority. And the cost? It's paid by savers, by future retirees, by anyone told that safety means sitting still. The market isn't rigged against you personally. It's rigged toward continuity, toward keeping the system alive at all costs, even if that cost is hidden, slow, and unevenly distributed. Here's the irony. The safer the market feels, the more dangerous it becomes. Because risk doesn't vanish. It accumulates. In leverage, in correlations, in expectations that nothing bad will happen. And when something finally does, a rate shock, a liquidity freeze, a political fracture, the calm breaks all at once. Not gradually, not politely. And the people who thought they were protected discover they were just last in line. So what do you do with this? This isn't a call to panic, or to abandon markets, or to chase the next shiny asset. It's a call to see clearly, to understand that safe is not a guarantee, it's a label. And labels are often designed to make systems function, not to make individuals wealthy. The uncomfortable truth is that modern markets are engineered for stability, not fairness, for smoothness, not truth. And that might be necessary to prevent collapse. But it also means the old promises no longer apply in the same way. So here's the question to sit with. If the safest markets are no longer safe, and the riskiest assets are no longer priced honestly, where does real security come from now? Because the answer isn't obvious. And whatever it is, it probably doesn't look as calm as the market wants you to believe.